Recession fears slamming Wall Street Wednesday. The Dow falling more than 760 points at one point, but paring back those losses. Right now, the S&P 500 down 2.5%. Well, amid this tempest, let's go to an ocean of calm. We'll go out to Santa Monica, California, where we're joined by Ross Gerber of Gerber Kawasaki. And Ross, by the way, congrats on the Diversity Award for your firm.
Thank you.
Today, a closely watched bond market indicator pointing to a renewed risk of recession. In this case, the 2-year yields going above that of the 10-year. So the market seems spooked by this. Ross, how seriously should we take this sign?
Well, I think you should take it very seriously. The bond market is rarely wrong, so I don't, like to bet against the bond market. I think the bond market's making a very clear statement right now, which is trade wars are horrible for the global economy, and Trump's America First policies are maybe good in some ways for America on the short term, but really bad for America and the global economy on the long term. And we're finally starting to see this roll over on top of all of the problems we're seeing between Hong Kong and then Brexit coming and the EU's economy being a disaster. I mean, it's just hard to jump up and down and say, wow, look at how great the economy is right now, And that's what the bond market's saying is, maybe the U.S. economy is strong today, but in a year, maybe it's not going to be.
So what happened then to the idea of a Trump put or a Fed put to save the day? For now, the market's saying, hey, this is it?
Well, the Fed can make a difference, and the market's clearly saying the Fed has to lower now 3 times to even get the yield curve looking correctly. And I think that's what the Fed has to do to keep the economy going here in the United States and also help the foreign markets. And so I don't look at that as good news that after tax reform and a really strong economy that now we're in an interest rate, lessening cycle because of basically horrible policies. So expecting the Fed to save us from really structural problems isn't really going to work that well this time, and that's what I'm concerned about.
Do you possibly see a correction ahead?
We're living it right now. So yeah, I think that once again, rates will support asset prices, and if the Fed, lowers rates 3 times, I think the market's in pretty good shape right now. And if you look at the inversion statistics, it usually takes about 12 to 16 months after an inversion to really see a recession. So, I don't expect that a recession's around the corner. In fact, today and most of the world, a lot of people are on vacations, having a wonderful time and hopefully not paying attention to the stock market. And they're not paying attention to the news. So this is a thing that I think a lot of people have to take into account. The average guy is not paying attention to the news, and they have jobs right now and they're spending money. So that's the backdrop of, hey, you know what? Even though the markets are scared, maybe it's a teacher. There's a lot of time to rectify the situation. And we're going into an election year where Trump really has to strategically consider that his policies might actually cause him to really lose this election in a big way. So I expect them to try to right the ship over the next several months.
So if that's the case, then you're not too worried about stocks falling much further then?
Not with rates going down. If I can get a better yield owning, Apple or Microsoft than on a treasury bond, plus with the cash these companies have and the business that they're doing and the growth of their businesses, it's a no-brainer. So I think it's all predicated on rates. Most recessions, remember, have come when the Fed was tightening interest rates and they over-tightened, like what the Fed did in December, and then the market immediately dropped 20%. But very few recessions happen where the Fed is preemptively lowering rates already. And if they take this decline in what the market's telling them seriously and continue to lower rates, I do think that it provides a cushion, but it doesn't fix the horrid Trump policies that are being implemented right now on trade. We need free trade and we need less barriers between countries and companies. And instead, what we're getting is the exact opposite. And I think ultimately, it's a lose-lose for everybody in the global economy.
And lastly, Ross, WeWork filed for an IPO today, the office sharing company, disclosing a $700 million loss in that first half. At the same time, however, revenue more than doubling. So when WeWork finally goes public, do you think it's going to become another money-losing Uber or Lyft, or is it more going to be like a Beyond Meat or a Pinterest?
I think it's good. I think it's going to make Uber look like a good stock. I think WeWork exactly proves my point that if WeWork can go public, things are really good in the markets and the economy, because companies like this should not be public companies, and they're far from profitability, and we actually question the actual business model. But I think it's actually a positive sign that companies like this are going public, because they really shouldn't be. So we've got this cross section between, frothy IPOs and lots of money flowing around, and then a lot of fear that's being driven by our government. And once again, it's an easy thing to solve. We just need to have policies that make sense and a president that doesn't tweet a different thing every week. But the market's had enough, and people are moving to the sidelines, and they're buying bonds, and it's hard to argue with them.
Okay, Ross, I'll check back with you, making Uber look good. All right. Well, thanks a lot, Ross, for your thoughts.
Thank you.
Our thanks to Ross Gerber of Gerber Kawasaki, coming to us today from Santa Monica, California via Skype. I'm Fred Katayama. This is Reuters.